On this week's podcast, we have an extra special guest. Does that give it away, anybody?
That was Cameron's Barry Ritholtz impression. This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore.
Episode 57. Yeah, I did my best Barry Ritholtz impersonation.
Yeah, as we noted in that intro there, that this is an episode we did with Barry Ritholtz. If you don't know who Barry is, he writes for Bloomberg, but I think maybe this is my own bias. I think the thing that he's probably best known for now is his Masters in Business podcast, which is huge.
I would think so. I mean, he's famous for making the call in the crisis of 2008, 2009, but that might just be more of a Wall Street thing. He wrote the book Bailout Nation. He puts out a daily blog. God knows how long he's been putting it out, but it's got to be 20 plus years every single day. He's an absolute news junkie. He's the chief investment officer of Ritholtz Wealth Management, which is one of the fastest growing RIAs in the U.S. He's a lawyer.
Oh, he's a smart guy.
He's a brilliant guy. He's funny. He's totally engaged. He's passionate. He's just a great, great guy. Welcomed us into his office in New York City, and it was hilarious.
He's all around an impressive guy, and he started this firm, Ritholtz, in his own name. It's very similar to the way that we've built our business at PWL, just in terms of the investment philosophy and the focus on financial planning and overall wealth management, as opposed to just jamming investment products. So we had a lot in common from that perspective.
Yeah, and kind of the anti-sales. Just put the information out there, and if people want to deal with us or with Barry, they just reach out, and that's how their growth has been. He basically told us how he got tired of turning down people who wanted them to help them with their investments.
Right, because he'd been writing for years and years and years, and people kept reaching out and saying, I want you to manage my portfolio. And he had to turn them down because he wasn't an advisor. So he eventually started a firm with Josh Brown, who's also fairly well known in this space.
Yeah, and these guys just like giving back. So we just reached out to him, and he said, sure, come on down. So we went to see him, and it was a whole lot of fun. So without any further ado, our conversation with Barry Ritholtz.
Barry Ritholtz, welcome to the Rational Reminder Podcast.
The Rational Reminder. I like that name.
We're very excited to have you on.
I'm thrilled to be here in my office.
In your own office.
And we must thank you, because it's you guys that really inspired us to do a podcast. We've been listening to your Masters in Business for years, as well as your colleagues, Animal Spirits.
I'm coming up on 5 years of Masters in Business in July 2019. The 250th episode is in the near future. Mike and Ben have been doing Animal Spirits, and that launched just over a year ago. And I said to them, you will be surprised how quickly the anniversaries start clicking by. When you're a little younger, you're not aware of how rapidly time goes by.
But doing a weekly podcast is no joke, as you know. Or is it because your head's in it all the time?
Yes and no. So when you look at like the really produced podcasts that NPR does or Freakonomics do, each podcast is a butt ton of work. I mean, they're producing a full mini film without the video. What I do, look, I tell people who are starting a podcast, make sure you go in, you're the most prepared person in the room, including your guest. You know, I become an expert at each of my guests before they arrive. I read all their books. I do their bio. Mike Batnick, who's our head of research, does a ton of work with me also, and he basically becomes an expert in them also. We create a list of questions across 4 or 5 broad topic areas. So yes, it's a lot of work, but let's be honest. I get a guy like Scott Galloway, who's been teaching the same course at NYU for 15 years, is an expert in that space. I just have to give someone like him a nudge and get out of the way. Michael Lewis, a few weeks before him.
Amazing interviews.
You just, so delightful. I'm at a dinner the other night with a number of notables, and Barbara Tversky, Amos Tversky's wife, comes up to me and says, I just have to say to you how delightful your interview was with Michael Lewis. So I'm beaming, and I said, Barbara, that's very nice. First time I ever meet her. Wow. That's lovely for you to say that, but let's be honest. It's Michael Lewis. You know, I don't have a lot of work to do. She goes, normally I would tell you that you're right, But look at the interviews he's done with other people, like Malcolm Gladwell. He goes, yours was just really, it was clear you guys were having fun. Well, I've interviewed him a bunch of times. I know how he thinks, and I've read all his books. She's like, no, that was really my favorite. And he told me that The Undoing Project would not have happened without her. She was instrumental to the book. So it's nice when people recognize it. But to be honest, I have the easiest gig in podcasting. I don't schlep around equipment. I get to use the Bloomberg facilities, which are awesome. Their engineering staff and their editing staff, these are the pros of pros. Bloomberg Radio has been around for forever. So I walk in, I meet really interesting people who I want to have a conversation with, and I have a conversation. It really is the easiest gig in podcasting.
All right. So you've got this easy gig podcasting, but you've also got this $1 billion firm. Can you tell us how do you spend your time? How do you spend a typical week?
So I'm very good at reusing a lot of the same time for multiple things. And let's talk about the firm first. We're an ensemble practice. We're 5 years old. It's 30, soon to be 33 people, 34 people, $1.1 billion. I do much less of the heavy lifting than we did in the early days when we were first launching. It was literally Josh and I writing notes on yellow pads and taking phone calls from prospective clients and calling them back. And he will tell you hilarious stories about he and I having a conversation in front of a client where he'll say something and me, being a high-functioning idiot, will say, yeah, that's not exactly right. And here's what – and people fortunately found it charming, but, any sales school or business place would tell you that's not how you do it. So we knew we wanted to specialize in what we each did best. We brought in Chris Venn, who is our director of wealth management and planning. He oversees all of the client-facing advisors, which are in almost a dozen cities across the country.
Really?
So we have New York, we have Florida, Newport Beach, California, Portland, Oregon, New Orleans, Chicago. We have 2 offices in Chicago, out in Long Island and Stony Brook. So, and we're looking to add in places like Norfolk, Virginia, and Charleston, and San Francisco, and Seattle, and Minneapolis, and Austin, Texas, where, there's a whole longer story. This wasn't, hey, let's build an asset management firm. This was after a decade or two of turning down money from people. No, I'm very happy just researching and writing and talking about markets. I was fascinated by behavioral psychology and behavioral economics in the 90s before all the cool kids discovered it. So I began as a trader, and I was just amazed as to all. Let me take an even bigger step back. And I wrote about this on the blog. I wrote about my bizarre academic career and my ass-backwards professional career. But I went to college expecting to be applied mathematics and physics major. And by my third year, I realized I'm pretty good at that, but I'm not great at that. And I'm surrounded by people who are fantastic at it. So, and I was not enthusiastic about all the hard work that went into it. And at the same time, I was interested in philosophy, and I was interested in logic and rhetoric and logical reasoning. So I switched to political science and philosophy, ended up spending 5 years at SUNY Stony Brook, eventually graduated and went to law school, although actually the order was opposite. I went to law school and then graduated college, but that's another story. But when you have that background that is fairly evidence-driven and logical and based in reality, stepping into the world of finance or trading or investing, it's just a myth-driven business that is mostly sales, or at least that's the way it was when I joined the industry. So I didn't want to do the sales. I just wanted to spend time debunking the myths, figuring out what was what. And behavioral finance was a huge – Thomas Gilovich's book, I think it was 1991, How We Know What Isn't So, just basically sent me down the rabbit hole. And from there, it's been, Kahneman and Tversky and Thaler and Schiller and Meyer-Statman and Dan Ariely, and work your way down the list of people who have pushed Dunning and Kruger, and the list goes on and on and on, who have pushed the boundaries of us understanding how we make decisions and why they're often so terrible. And to investors, that's an enormous insight that most people simply don't get usually.
So what is your mission? Is your mission like your own fulfillment to do things better? Is it to change the world? Is it to build a great big investment practice? Like what's really driving
which mission? You have to...
Your mission.
All right. So my deep, dark secret, which really isn't a secret, is I do everything to entertain myself. The blog started first on GeoCities in I think 98 or 99. Now remember, in the 90s, for you youngins, there wasn't Google Drive, there wasn't Box, there wasn't Dropbox, there was no cloud.
For the record, I'm not that much younger than you, Barry.
I'm talking to the listeners. So I started using the blog as a filing cabinet. First, it just became, where can I throw charts and documents if I want to find them either at home or the office or at the beach house or wherever you happen to be on vacation with a laptop? Like, people don't realize, wait, you didn't have access to your documents? No, there was no cloud. The closest thing to a cloud was posting a chart or a doc or a PDF on GeoCities. And when TypePad invited me to be a beta tester in early 2003, that was just, oh my God, WYSIWYG, I don't have to. So you used to take a half hour to write something and then about 2 hours to code it in HTML for GeoCities. That 2 hours disappeared. It went to 90 seconds on 6apart's TypePad software. And that was 03. In 08, I moved to WordPress. But the joke, which is really only half a joke, is I write to figure out what I think. And besides, it helps quiet the voices in my head. And it really is an audience of one. And it's very freeing to not care about clicks and to not, hey, it's nice when something goes viral. It's nice when something gets picked up and shared. I did a piece last week it's Monday. It was this week. I wrote it last week. It published early Monday, called 10 Terrible Things People in Finance Say. And I thought that was like a simple piece that was just annoying me. Like, to me, once I get it out, it's a little cathartic. All right. And it was the most read piece on the Bloomberg terminal. It got shared all over the place. That's gratifying. That was not a piece I expected that to happen. It was just, I got to get this out to stop the tumors from forming. So the podcast is the same way.
Can you talk a little bit about, so you've started this RIA, which for our listeners in the United States, an RIA is a firm where there is a fiduciary requirement.
Right. Where RIA, if you're over $100 million, you're SEC regulated. It's not FINRA. It's not a brokerage firm. It's not commission-based transaction. We are fiduciaries to our clients. It's fee-based. We sit on the same side of the table as them. Their best interest is what we're working for. I expected this model to take over the industry 20 years ago. I have been consistently wrong. Maybe it's longer. Consistently wrong as to how soon the brokerage model would collapse. It continues on, and in some places is getting stronger. Morgan Stanley is doing great. Merrill Lynch and UBS are still attracting assets, although they've introduced a little bit of a hybrid BD RIA, a brokerage RIA version. But I spent the first half of my career turning down money. I didn't want to be bothered. First, I don't want to be infected by the emotional virus that the humans have. And second, the back office, the administrative, the accounting, the compliance, it's just such a pain in the ass. Let me just sit in my office and think about stuff and write what I hope is reasonably intelligent and somewhat unique perspectives. When I brought Josh Brown onto our old firm where I was working, he had spent the previous decade running a brokerage firm, working in and eventually running a brokerage firm. And he knew exactly how hard it was to get people to give you money when you ask. And he said, dude, you can't, when someone says, here's $1 million, please take it, you can't say no. So I said, look, here's what I don't have any skills at. I don't have the back office skills. I'm not a salesman. I tend to say what I think, not the best thing in front of clients often. And the running of an office and managing staff, and I suck at that stuff. All I want to do is think about the broader philosophy of the firm, manage the assets, and set the tone in the direction of what we should do. He's like, great, I'll do everything else. Let's get started. No bullshit. It was that short of a conversation. and everybody has seemed to have found their role within the firm. So when Josh says, I want to be when we launched this, I said, I'm going to be chair of the investment committee and chairman of the firm. We have to find a CEO. And he said, I'll be CEO. I ran a brokerage firm. No brainer. Really talented guy, can manage people. We all do media because people seem to appreciate what we have to say. We brought on Chris before we launched the firm, who basically would pick up yellow pads. This is an absolutely true story. He would pick up, what are these? Oh, those are a bunch of clients. You should, or prospects. You should call them. What do you mean? Well, they're people who called us and said, take my money, and we just haven't gotten back to them. So our methodology here is a little different. I've sort of half jestingly said it's a European model. Basically, our model is crank out a whole bunch of high quality, valuable contents and have it seen or listened to or read by lots of people. And if 0.01% of them say, we'd like to become clients, well, A, you've helped 99 point something percent of people understand what they should be doing with their money better. And B, hey, that's a couple of bucks a year. That's a pretty good model. And you'll notice we're here during market hours. The phones aren't ringing. There's no TV in the background. Nobody is working their leads. It's not how we, I've called this our exorbitant privilege, that we actually get to sit and think about what we should be doing and what's optimal for clients and not get caught up in chasing business. Chris spent the previous decade at Wells Fargo, where when he was very young, working for two senior brokers, and they hated all the seminars and stuff that Wells Fargo spent hundreds of millions of dollars creating and doing. This is before they lost their way and became the force-placed insurance capital of America. But the Pareto system and all these different, here's how to manage clients, here's how to manage a model, here's how to manage clients' communication. He's a wizard with that, and I didn't want to do it. Josh didn't want to do it. He set up an entire system so that when an inquiry comes into us, email, website form, phone call, or we've literally had walk-ins. We've had people walk in the old office, so you need a card to get in here. In the old office, you could just push a button. In the old office, before we launched RWM, you could push a button and just go to 25 and the door's open, and we would have people literally walk in and say, hi, I'm here to open an account. Hey, we're not a bank. So Chris did a number of things. That system, turning that into a finely tuned machine, is what he set up. And we knew we were interested in financial planning, but neither Josh nor I are CFPs. Chris is. We're going to end up eventually, we'll end up with about a dozen CFPs by the time 2020 is over. I think we have 7 or 8 at this point, and 1 or 2 more who are coming on with us. He didn't take a whole lot of convincing to say to Josh and I, we need to integrate planning into the front end of what we do. And our process of bringing clients on is to do a very light version of a financial plan before they're clients. After they become clients, they get the full-blown plan. But how do you recommend a portfolio to someone if you don't know what are their assets, what are their goals, what else do they need, what's their cash flow like, what are their future liabilities and obligations, what are they saving for, what do they want to do with the money? I say to people all the time, why do you want to have money in the stock market to just beat the S&P? Towards what end? You're taking on additional risk, you're assuming additional volatility. Why do you want to just beat your neighbor for no purpose, when in order to win, you're taking a chance of not only losing, but losing big? The flip side of performance is underperformance. The flip side of gains is assuming risk. There is no gain without the possibility of loss. That's how it works. People need to understand that, and planning does a really good job with that. If you can reduce the amount of risk and hit all your goals, isn't that better than otherwise just own 100% of the highest beta stocks there are? And, when an 08, 09 comes along, so you'll be down 60, 70, 80%. But hey, Amazon came back. All these stocks came back. Do that. You're not going to sleep well at night and you're going to worry all the time, or give up a little performance, have some bonds to offset your equity. But all these thoughts, the whole philosophy of this integrates very much into how we designed the firm, built it, integrated behavioral finance into it, and really just tried to come up with a model. We didn't want to be different for difference sake. We looked around and saw a lot of things we didn't like. And what we didn't like was the way people were performance chasing and overcharging and basically running this insane sales machine on most of Wall Street. We wanted to do something that was a little more erudite and a little more thoughtful, and that worked out better for clients. P.S. We all eat our own cooking. Everybody here is an investor in the same portfolios the clients have. All our 401ks are the exact same portfolios that clients have. And we started out as a 2-partner firm. We're now up to 10 partners. We're becoming an employee-owned firm. Everybody participates. Everybody eats their own cooking.
I want to dig into that a little bit more, Barry. Can you talk about, you mentioned you wanted time to sit in your office and think about the direction and philosophy. What is the firm's investment philosophy? Like, what does a portfolio look like?
So we believe that people should own a low-cost, globally diversified asset allocation model that avoids the behavioral issues that everybody has and simultaneously incorporates what we know to be true, which is very little. So that means we use broad indexes and ETFs. We know that value and small cap over long periods of time outperform the overall market. They've stunk the joint up over the past 10 years. We know, but will eventually mean revert. We know that people have a tendency towards home country bias. In the United States, there's even a home state or regional bias. Wow. They've done studies. We've seen, I've read the academic literature. If you're in Texas, you have a disproportionate, or that part of the South, you have a disproportionate amount of energy. If you're on the West Coast, you have too much technology. If you're in the Midwest, you have too much industrial and manufacturing. If you're in the Northeast, you have too much finance and banking. People go with what they're comfortable and familiar with. Comfortability and familiarity are not how you do okay or better in the market. So we're probably about 50% overseas, 50% US, more or less. That's equal weight to what the world is like, but that's high relative to what most people are like. So the good news over the past couple of years with the US doing well, the people who suffer from home country bias are doing pretty well. The bad news is they got shellacked in 07, 08. They got killed in 2000. And very often when you go through an event like that, you don't stay fully invested all the way. Capitulations occur. The word capitulation means surrender. Capitulations occur when enough investors throw their hands in the air and say, I just can't take it anymore. Get me out. I don't care about the price. Bottoms are made when enough people puke up stocks and say, I'm out. Those are the worst times to be a seller, and those are the best times to be a buyer. Very, very difficult to fight the crowd as either a professional or an amateur. We got lucky a couple of times, but that's not what we sell to clients. That's not what we offer to clients. Our perspective is nobody consistently times the market. So let's own the whole world in a rational set of performances. We use Vanguard and dimensional funds and BlackRock and DFA. I said DFA already. Vanguard, BlackRock, dimensional funds, Wisdom Tree. So we have a slight value tilt and a slight small cap tilt, but we're global, we're low cost, and it's really simple. I think Wall Street tries to make things more complicated because there's big money in showing this is really intricate and complicated, and you need smart guys like us at a high fee to walk you through it. The entire pension and endowment sector has bought into that bullshit, and it's really embarrassing. They should be ashamed of themselves. Every time I look at a pension fund, every time I look at a private foundation, I want to say to these people, what consultant sold you this bullshit? This is nonsense. And they're promising you stuff, but you just have to look at your past 5 years of performance. I don't think institutions need a 60-40 portfolio. They don't need that much bonds for a perpetual set of holdings with liabilities off in the future. But the 40% is for the people who are on the board to not lose their minds every time the market does what markets do and go through its regular convulsions. So I look around at that sector of the industry. The fees that I've seen are 3% for foundations, 3% for non-public pensions. There was just a piece in Institutional Investor today that not only is Yale underperforming the S&P, the Yale endowment, which was lauded for the past decade, they're like 80% non-liquid investments. So I guess some people think you need to own forest lands by the hectare, but you can keep it simple. You can keep your costs down. There was a wonderful Wall Street Journal article a couple of years ago about the guy running the Nevada pension fund. It's one guy. He goes into his office. He has his tuna fish sandwich, and he basically plays Minesweeper all day. Yeah. And I think he makes $150,000. Compare that to any other endowment of this. Now, maybe that's extreme. You don't have to go that far. But to pay a 3% annual fee on illiquid investments across the pension industry, plus consultants, and it's amazing how calcified that sector of the industry is. And it's amazing what sort of an agency problem exists that boards don't want to take responsibility. So they pay expensive consultants to put them into crap, which I like to describe as come for the high fees, stay for the underperformance.
But it's not just foundations, though. Like I've seen some pitch decks from the biggest banks here in Manhattan that are pitching these alternate asset classes that behave differently compared to the rest of your portfolio.
Well,
it looks like they're sales shops for all this kind of stuff, all this alternate stuff.
Totally. It's, the biggest shocker after I wrote Bailout Nation was that people still didn't understand how the financial crisis happened. And no, don't you understand? I just spent 300 meticulous, laborious pages explaining the many, many inputs into this crisis. We've resolved this. Can we move on? And it continues. And that was like a giant wake-up call that you can't. So the answer to one of your original questions was, what's your personal mission? When I was younger and more naive, I used to believe you can change the world. And now I'm a little less ambitious about that. And I think you can change the viewpoints of people who are willing to have their viewpoints changed. But if someone tells you, and I don't want to do politics because it's too easy, but if someone tells you, I think I could beat the market, I think I could pick stocks better than an index, well, I could show them an overwhelming amount of data that statistically it's highly improbable that you will do any better than for a month or a quarter, you'll beat the market, maybe a year or two. But you're not going to be Bill Miller. You're not going to be Michael Jordan. You're not going to be, you can go out and practice 3-point shots all you want, right? You're not going to get drafted by the Golden State Warriors.
I mean, even Bill Miller couldn't even keep being Bill Miller.
Right. And I use the metaphor. I like cars. I like to drive fast. My mom says the first word I ever said was cars. So I get up to Lime Rock whenever I can, or Monticello Motor Parkway, and not as much as I would like to, but occasionally. And the parallel is, if you set the course speed record on the straightaway, but then you plow in the wall at the end because you don't make the turn, that doesn't count. You don't get the course record. You have to survive that last turn. If you plow into the fucking wall, I don't care about the speed record. It's not a drag race. It's a track. And so the people who outperform consistently for a few years and then blow up spectacularly, all that tells you is that they're taking so much risk that their upside is great, but you can't ignore the other side of that equation. The downside of just stomping on the accelerator and holding on to the steering wheel and going down the straightaway, but being unable to make the turn, is you die at the end. That's a bad strategy. And that's what we see with not all. Look, there are enough people who have consistently outperformed the market over time that I don't buy into the claim that it's pure luck. But, there are Steph Currys and LeBron James and other people who are just so far ahead of the rest of their competitors. They're unique. So what Jim Simons put together at Renaissance Technologies, D.E. Shaw, Ray Dalio at Bridgewater, Howard Marks at Oak Tree. All these people doing very different things. T. Shaw and Renaissance is sort of similar. But Howard Marks in distress, I could give you a run of 100 people. There are 100 million investors. So the fact that there are 100 people we know about who've consistently beat their benchmark year after year after year, that shouldn't encourage people to try and do it. That should remind people how hard it is. You can have a pretty good outside shot in basketball. You can play. You can have a good crossover dribble and, a pretty consistent foul shot. Statistically speaking, the odds of you becoming the MVP of the finals is pretty close to zero, right? You're more likely to be struck by lightning. But you could say that because I could look at the numbers and say there's 100,000 high school athletes and 8,000 college athletes and 2,000 NBA players or whatever the number is. I think it's even less than that, 1,000 plus the minor leagues. The math is clear. It's obvious. It's even worse in investing. And yet people, ego-wise, want to believe that they can do it. I'm very comfortable if someone says I'm going to take 5% of my portfolio and put it in a fund account and I'm going to buy this and sell that. You can do angel investing. You could buy art, buy collectible cars, buy whatever you want. If it works out, great. And if it blows up, be happy it wasn't your real portfolio. And even if it works out, I'm going to say, if you own Amazon, look at how many times Amazon has it, 80 or 90% drawdown, right? If your whole portfolio is in Amazon, you can't survive that. Your head will explode. But if it's a couple of shares off an account you don't even look at, that's fine. But you have to understand that 5% that's it, and you're not going to add anything to it, and that's your play account. When it's zero, it's telling you, hey, you suck at this, just leave your real money alone. That's a tough concept for people to grasp. Even when it goes to zero, their ego will not allow them to admit that they're not good at that.
Going to zero is probably the best outcome because then they might learn a lesson. If it doubles, that's probably the worst outcome.
I've told people the worst who tell me they're going to Vegas for the first time. I always say the same thing. Hope you lose all your money. And they think I'm being obnoxious. And they say, why would you say that? I go, because the worst thing in the world that would happen is you go to Vegas and make a bunch of money. Because now you are engrammed. Your memory is now etched with the thought that you're skillful, not lucky. And you will spend the next 40 years suffering the repercussions of that. Go to Vegas, lose some money, never go again. Go to a show, go to a restaurant, that's great. Don't think. We were at the SALT conference in 2013 or 2012 or 14, around then. And I remember it was at the Bellagio, and the Bellagio owns these two Monets. And it's literally velvet rope. You have to get online. And I'm next online to view these. And there are these two really big tourists, a husband and a wife with a heavy Southern accent. And they're looking at the painting and they don't know what to make of it. And the husband says to the wife, come on, honey, let's go in the casino and win us one of these Monets. And I want to say, you understand they own a $40 million painting because you go in there and lose money. You're going to subsidize this with your gambling. People don't get that. And when you look at the profits in Wall Street and you look at the profits that are extracted by either high fees or excess trading or IPOs or go down the list, that's where those profits come from.
So Barry, we're doing portfolios. I mean, when you're describing your practice, I'm thinking, I was smiling because it sounds to a T identical to the way that we think about things and implement things, which is interesting. You also mentioned that you love the behavioral side. Can you just talk a little bit about how you're approaching the client conversations because small cap and value, like you said, have stunk up the place for the last 10 years?
So to answer that question, I'm going to step back and say how clients find us. So I've been writing publicly for 20 plus years. The blog is going to be 5 years. I've been doing television since 2003. Right, pretty much got the financial crisis right. Warned about housing and derivatives and subprime in 05, 06, 07.
Really?
Oh, yeah, in print, at thestreet.com, on the blog. I wrote a piece for thestreet.com. I disagreed with Michael Lewis about something. Apologies for the name drop again. I interviewed him at the Inside ETF conference, and he said something, and I'm now coming around to his view. He said, I'm amazed when you write a book, it's not the book that people read. Your intention and what you think is important is very different than what people perceive. And I'm like, no, I don't see that. And now I'm kind of getting what he says. So I wrote a piece for TheStreet.com called The Cult of the Bear. And the whole concept in 06 or 07 was so I was warning that housing was falling. I was warning that this is a wonderful chart of the relationship between median income and median home price in the United States. It goes back like 100 years. And it's a sideways squiggle for most of those years. And then in 01, it just goes straight up. And by 06, it's like 4 standard deviations away. And you can look at that in other ways. Cost of renting versus cost of ownership, same chart. The value of homes in America relative to GDP, same chart. And really the solution to that is either everybody's salary is going to triple or housing prices are going to come down 30, 40%. Well, we know what happened. And I was talking about this and writing about this in public. So I wanted to do an exercise, and the market kept going. Housing was faltering. Nobody wanted to believe it. So I did a piece saying, if this is correct, and if people like Reinhart and Rogoff are right, and that financial crises lead to markets getting cut in half, a 10-year weak recovery, housing prices losing 30%, that's their research and data before the financial crisis. If that's true, what's fair value for each of the companies in the Dow, and what does that work out to be? So I, again, pretty meticulously worked my way through how dependent is Bank of America and General Motors on financing, and you go through everything, and how does it affect the profits? And I come up, I think the Dow is about 13,000 and change. And I come up with a ballpark number of about 9,800 for fair value. But then I presciently write, and this is a number I just made up. Hey, if the Dow falls from 13 and breaks 10 and goes to 9,800, it's going to cause a 3,000 point panic. And I think my initial number was 4,000. A friend said, no, it's 2,000. And I said, let's just split the difference and go 3,000. And so we could see Dow 6,800. And so when Business Week sees the piece and says, do you want to participate in a year-end forecast? I'm like, sure, but this isn't a forecast. This is just do you want to participate or not? Okay. This is when Business Week was part of McGraw-Hill. And so I put, I draw the parallel numbers and I put Dow 6,800. And I think the S&P was like 750 was the forecast, whatever it was. And not only am I an outlier, I'm an outlier by
You're the nut.
And I'm doing Kudlow pretty regularly, and he has me on, and he's apoplectic. He loses his mind. And so I try to say, to Michael Lewis's point, look, don't pay attention to 6,800. The issue is housing is a key part of the economy, and if housing falters, what does that mean for look at the builders. The builders were already almost cut in half at that point, right? You look at 06, the builders were getting shellacked. In 07, the mortgage companies were getting, it was 05, 06, 07. It was builders, then mortgages, then banks and brokers. They were all rolling over. They were telling you, if you believe markets contain information, that something wicked this way comes. Nobody wanted to hear that. It was just, we had just lived through the dot-com collapse. And I wrote a piece in 03 that says, expect to see a lot of ups and downs, but typically it takes 10 to 15 years to work through a collapse of this sort. So to think that 5 years after the market bottomed in October 2002, we were setting new all-time highs and that was sustainable, that goes against everything I've seen historically about bear markets, about recoveries, about cycles, about washing out the excesses. It just seemed too fast and easy. Right? That's a squishy, non-quantitative way of analyzing it. But when you look at the historical cycles, this was just way too soon. And then when you looked at all the excess in derivatives and subprime and securitizations and housing, my favorite story was, I don't remember if they were grape pickers or strawberry pickers, husband and wife, working immigrants who buy this house in California for, it was close to $1 million. I don't remember the exact number. But the key takeaway, I sat and I looked at their salaries and I looked at the mortgage, no money down, 100% financing, and I calculated their monthly mortgage and said, if they take 100% of their pre-tax income and use it to pay the mortgage, they still ultimately default and lose the house. How is this possibly sustainable? So I'm dumb because I didn't figure out a way to short that side of it. Right. The firm I was with at the time, we were short Bear, we were short Lehman, we were short AIG. Again, if I was smarter, we would have married a put to that. Very difficult to be short Lehman on the way to zero. Very difficult. It just kept ripping back up in your face. So even knowing or having a good idea what was going to happen and even being in the right things, it's still hard. And I think we finished 2008 flat. We should have been up much, much more. In a year where the market was down 38% and fell 57% peak to trough, like I had that about as right as you're going to get it. And still, I know breaking even in that crisis is great, but it isn't. Like after the fact, you realize, you should have been up, 500%. The lesson I took from that was, we could, based on this track, and then, and March 2009 went on TV and said, you can cover your shorts here and go long. Everything is as oversold as it ever gets. Now, I happen to do that the day before the bottom. If you would have asked me the same thing 3 months earlier or 3 months later, I would have said the exact same thing. That's just dumb luck of the timing. We could have taken that track record and launched the hedge fund, raised $1 billion, taken a lot of cash out, but then 2 years later, all that money would have fled. Instead, I tell people, look, with all due humility, I don't know anyone who got the top and bottom better than I did, and I don't want to run money that way. I don't want to run my own money. I don't want to run your money that way, because how do I know I didn't just get lucky? How do I know that or let's say I'm really skilled in identifying that boom and bust. How do I know the next one is going to be remotely like this and I'll have that skill set? This isn't false humility. This is just Aristotle saying the only thing I know is that I know nothing. So I extrapolate that forward and say, how do you really know what you know? And how can you separate your own impression of your skills and intelligence from just dumb luck? And most people don't like to do that analysis. Most people prefer to say, no, I'm really smart. I'm good, and therefore I deserve a higher quality of life and a bigger paycheck. And give me your money because I promise you we'll get out before the shit blows up. And that's just nonsense.
I got another question for you, Barry. You guys are running portfolios in a way that's very systematic. You guys are doing content that anybody can get for free. What do you think the clients of RWM see as the biggest value add? Like, what are they getting in return?
Oh, that's easy. That's the behavioral counseling. That's what we do, and we do it in a lot of really subtle ways. Some are overt. When we bring people on the process, we don't just take people as clients. We make sure they understand what we do, and we try and figure out what they want. If someone calls up and says, what's your Sortino ratio? What's your Sharpe ratio? Like, we're probably the wrong fit for them. Yeah. They either read something I had written a while ago, or they saw Josh on CNBC talking about a given stock. And, I love that he goes on that game show and is the voice of reason amongst traders. Listen, I started as a trader. I loved being a trader. I don't have anything against people trading, either professionally or with their fund money, but not with their retirement savings, not with their real money. So the idea of using behavioral finance to affect people, we found some of it's really dumb and some of it's really insightful. We've told people who need money for real short-term needs, a house or college, that they need to be in the most conservative portfolio, and have gotten pushback from people saying, well, I'm not politically conservative. No, it doesn't mean that. So we changed the names of our portfolio. I'm a space geek. I'm an astrophysics junkie. So our portfolios and our robo-advisors called Liftoff, liftoff.today or liftoffinvest.com. And we used portfolio names relative to how far the NASA missions went. So Pioneer, Discovery, and Voyager are just Mars, Jupiter, and out of the solar system are relatively conservative, moderate, and the most aggressive. And people kind of not everybody gets upset when you call them a conservative portfolio, but it's come up enough times that, like, all right, my pattern recognition engine is starting to see that. We created a fee discount for good investing behavior. We call it milestone rewards. After 3 years, which is what the data shows that investors tend to get bored with a mutual fund holding, we discount their fees an additional 15%, assuming they've done their financial plan, they haven't logged into TD or Schwab and day traded their account, that basically they're buying into the philosophy. We give them a pretty substantial discount. We spend a lot of time debunking nonsense, getting people to think about long-term and not dealing with the availability bias or the recency effect or all the overconfidence bias, or there's so many different things that people do that are just natural human responses that we really spend a lot of time trying to show them the context of this, that market drawdowns and crashes are inevitable, that recessions happen all the time, that these things are cyclical. And if we had any confidence that anybody could consistently forecast them, well, then we might swing in and out of portfolios. But, all you needed to do is be wrong once, and all the lucky calls beforehand turn out to be meaningless. So we integrate a lot of that. I'll send you the link to this. I actually put something together on the site talking about how we use behavioral finance in our practice. And again, I don't care if other advisors want to do that. We created a series of things that we think have been really helpful. And, once people understand they're investing towards a goal and how the market did last week, last month, last quarter isn't relevant, and that drawdowns are inevitable, and people selling snake oil and promising you, I will get you out in time and then I'll get you back in. Once they realize the statistics and the evidence about that, it's a very different conversation, and all of that is behavioral.
So you mentioned Liftoff, which is your robo solution as part of your offering. There's a lot of very large robos here in the States. Can you talk about your opinion of the future of robos, especially in an industry where there's now one-ticket solutions from Vanguard, where you get instant diversification in one ETF for a couple dozen basis points?
So it really depends on who you are as an investor and what level of service you want, right? So you could use Betterment, you can use Wealthfront. We use Betterment as the back-end engine of Liftoff. They're the third and final attempt. We've gone through 3 different. We started with one company, and like a month later, they got bought by someone else and they orphaned the product. And then we went to a different company. It wasn't really their core focus, but they promised all this time and attention on it, and that eventually faded. And finally, we said, if we're going to do this, we need someone who's going to stick with it. Betterment has a good back engine that works, and it's seamless from when you land on the site to when the account is. There's no manual intervention. Now, if you have $50,000 or $100,000 and you never want to speak to a person and you just want to be online, there are a ton of cheap solutions for that. If you have millions of dollars and have complicated tax issues, you have trust and estate issues, and there's going to be a generational wealth transfer, and go down that list, you need a different level of service. That middle is where people kind of need a little more help, but they don't need to pay a butt ton of money. And so what we created with Liftoff is we took one of our CFPs, and they work exclusively. Matt Laureus works exclusively with Liftoff. Clients get to speak to the same CFP. It's not like calling a call center and some random person is signed. They're not going to need tax planning. They're not going to need estate planning. They're not going to probably not need the sale of a business or all these other complicated things. They don't need a muni bond sleeve, and go down the list of things that the higher net worth investors want and or need. Hey, they want a decent portfolio of quality holdings, but they want a little bit of a plan, a light plan. And so we end up doing this. It's if the average fee is 100 basis points, this is 50 basis points with a live CFP. It's not full naked robo, no human, just software only. And it's not the full service. It's in between. And it's not to do this without a call center, to have a single person that you're dealing with is a nice solution to that. We started with the robo because we hated with the software-driven algorithm-based allocation model, because we would get inquiries from people for $50 or $100 or $200,000, and we hated sending them out into the wild because the wolves are going to smell a wounded deer and just take them apart. And so this allowed us to say, we're running your portfolio. We're overseeing what's going on here. We're using this back-end model. It's pretty much all Vanguard funds. So it's really, the internal expense ratio is really inexpensive, but you have somebody you can speak to who is a trained CFP professional. And it's more than just, fill out this form online, click a button, and then you'll get quarterly statements. So far, so good. We're enjoying working with Betterment.
So we have solutions like that and firms like PWL in Canada, which is kind of like an RIA equivalent in the Canadian space. With solutions like that out there, how do you think it is that commission stockbrokers and actively managed mutual funds, those are still flourishing?
I don't know. I've been wrong about that for 20 years. I've been saying to advisors who are brokers in the 90s, dude, you have to move and it's all dudes, you have to move your business over to fee-based. It'll be painful for a year or two, but it's so much better than being dependent upon what happened last week, last month. You could just look at the commission business and how it spikes on the last day of T+3 within a month, meaning the last day you can execute a trade and still have it appear in that month's commission runs. It's such a commission that last day, like the 27th, there's a giant spike. That tells you all you need to know about the motivation of that side. Now, I know a lot of guys who are brokers who actually care about their clients and they don't engage in that sort of nonsense, but they're the exceptions. Most brokers treat clients, let me phrase this precisely. When you incentivize somebody to harvest the client's organs for resale on the black market, they will harvest the client's organs. Incentives matter. We know this from economics. If you say to somebody, here's 1% or here's 75 basis points and make sure I achieve my goals, they'll do that also. But the flip side of that is, they just passed a new rule in the United States called so intellectually dishonest. So it used to be you either a fiduciary or and follow the fiduciary standard as an RIA, or you were a broker, in which case you would follow the suitability standard, which pretty much says don't put Beyond Meat in the IPO in grandma's portfolio. That's a suitability standard.
Do you see a time when this fiduciary standard forces people to recommend index funds? Is that day ever going to happen? Because your guys, Michael and Ben, I think had a chart on one of their blogs a couple of weeks ago about how little of the market is actually in index funds, like 13% or something, a tiny number.
So the fiduciary standard says that you have to put the client's interest ahead of your own. Now, if the client says, look, I understand and appreciate indexes, but I think technology is going to be great, so I want at least a sleeve of technology. Now, there's a spectrum. I don't think that you're going to ever be able to say you're 90% Amazon and 10% S&P. That's a little, but if someone says I want 5% or 10% of my portfolio I'm not a fan of private equity or venture capital or hedge funds, but if someone wants to put 5% of the money in a couple of startup entities, as long as their real money is growing and doing what it's supposed to do is fine. So to turn around and say it must be indexes, there's a credible argument to be made that indexes overperform towards the end of a cycle until that cycle tips, and then they underperform. Because just look in the late 90s, the S&P 500 was wildly overladen with Dell and Yahoo and Microsoft and Qualcomm. Think of the big companies that, because it's cap weighted, it's the Nifty 50 all over again. So there's a credible argument to be said, hey, if you're going to index, you should do either a fundamental weighting or an equal weighting or whatever. I could take that argument. And, here's where things start to get complicated. Some of the arguments that are made talk about investor choice. And I think there's a difference between saying you must invest this way versus you must have this standard of care, this quality of care. So the standard should be your best. You go to a doctor, you go to a lawyer, you go to an accountant. They're obligated to put your interest first. There's no reason why financial professionals shouldn't have that same standard of care. However, it doesn't mean that a bureaucrat or a regulator should say, and this is how you should invest. You and I know how people should invest, and it's up to us to engage in that debate in the marketplace of ideas. And you just have to look at the flows going from active to passive, going from expensive to cheap. We're winning that argument. It's a long time coming. It's slowly and surely developing, but it's not an argument that, needs regulation to say, teach people how to invest and make them invest this way. It's happening organically.
Okay, so you've had this firm since 2013.
Right. We just celebrated 5 years in September.
So working with clients, being involved in the financial advice process, all that stuff. Is there anything since you've started dealing with investors and going through that whole life cycle, is there anything that you've changed your mind about over that time period?
That's a really interesting question, which is a great delaying tactic while I try and think of an answer. People, whenever anybody says to me, oh, that's an interesting question, I know they're like, oh, so you got nothing on their fingertips. What have I changed my mind about? I changed my mind about a lot of stuff on a regular basis. So we've had, I'll give you an example, and this is more philosophical than specific. I used to make fun of the efficient market hypothesis all the time. I just thought it was kind of absurd. But really, I kind of figured out that I was making fun of the strong EMH, the most extreme version. And I wrote a piece, I want to say it was like 2005, called The Mostly Sorta Eventually Efficient Market, which basically is an argument for a weaker EMH, meaning, yeah, markets eventually reflect most of the information that's out there, but it doesn't get everything right. Josh, we were having a conversation the other day, told a story about the closed-end fund Cuba, which has nothing whatsoever to do with the island Cuba. But when President Obama opened up relations again, that thing spiked like a ridiculous amount. But, Eugene Fama would say, yeah, but eventually it came back down to where it should be. So markets are efficient. That doesn't mean people aren't occasionally dumb or irrational. And it's sort of ironic Shiller and Fama won the Nobel together, because I think Fama was talking about the middle of the cycle and Shiller was talking about the ends when the animal spirits run amok.
Interesting.
I've kind of become more generous in my interpretation of EMH in that the bottom line to Eugene Fama of Chicago is, for the most part, people are not going to beat the market, certainly not over large periods of time and certainly not with large sums of money. You can beat the market occasionally for a stretch. Renaissance Technology, 40%, their medallion fund, 40% a year for 35 years. That's Michael Jordan. That's an outlier. You're not going to do that. That's 300 PhDs in mathematics and applied computer sciences looking for a whole series of small gains. That's not buy this, sell that, jump in here, jump out there. So I've kind of moderated my view on that. And the other broader issue, so I don't want to say I was an inflation truther, but I was, especially in the 2000s when inflation was running amok, I was pretty regularly calling out the BLS for understating inflation and pillorying the Boskin Commission, whose sole purpose in life was to reduce the cost of living adjustments in any backhanded way they could to reduce COLA increases for Social Security, and I don't remember if it was Medicaid or Medicare. I think it was Medicare. So I've kind of flipped on that. And, the way I came about changing my view on that was Professor George Box, who said, all models are wrong, but some are useful. And that framework allowed me to say, oh, BLS can be wrong all they want on employment, on inflation, but it's useful to see a similar set of inputs and outputs and to BLS's credit, I used to get into this argument with people, inflation is unemployment is wildly understated. Which unemployment? The BLS does 6 different levels. The main one they report is U3, but if you look at U6, I was at some conference and someone started lecturing me about U6. And not to be arrogant, I say, Google U3 versus U6. The earliest piece you're going to find on is something I wrote 15 years ago. So please don't lecture me on U6. If you want to include the full list of people who are unemployed, marginally attached, working part-time, okay, so unemployment's higher than, but that just means where you're moving the numbers up and down, the line, the shape and the angle of that line is the same. It's just whether you're going to start at 3% or 5% or 7% or 9%. So I've changed my mind about economics. I've changed my mind about BLS models. I still think they're wrong, but they're useful. And that was the biggest change of my mind about all these things, is really the concept that the world is complicated. There isn't a whole lot of black and white things. Everything is shades of gray. And that, was a realization that took a long time to wrap my head around, because all people talk about in politics or on Twitter or wherever is, this is black. No, that is white. And the real world is everything is a shade of gray. And that's a very nuanced, dare I say, mature perspective that took me half a century to figure out.
It's a great answer, and it made me think of one more question, if that's okay.
Sure.
So we talked about small.
But by the way, I feel morally obligated that I've tied people up for 2 hours in my studio at Bloomberg that I can never say, well, that's about enough. I'm thousands of hours in the hole, so I need to recapture some karma points. So ask away.
Okay, thank you. We talked about small cap and value, and we were just talking about changing your mind. One of the questions we get from clients sometimes, not that often, but sometimes, we're in this decade of underperformance. At what point do we change our mind? At what point do we stop pursuing the small cap and value premiums?
There was just an article I linked to this morning from the CFA Institute called "The Small Cap Premium is a Myth." And lots of people have said this. It's a liquidity, it's a risk premium, it's a liquidity premium. Here's the problem. Historically, the time when people make those decisions is just about when that flips. So I have a friend who runs a hedge fund and has been running a hedge fund for 40 years. And he's a one-man shop, but he's done pretty well for himself and pretty well for his clients. And he's a bear, he's short most of the time, so that's a huge disadvantage. And he tells me that his best market indicator is when people start taking money away. When people say, listen, I like your analysis and I think you're really smart, but this short trade of XYZ, and he's not just short the market, he's short specific stocks, which is hard to do when the market's going up and up and up, even though there may be fraud or accounting malfeasance or just profit collapse. And he said, when enough people take money away, I just want to double down on everything, because invariably that's the point where it flips. On the value side, you saw value reassert itself in Q4 2018 when the market, peak to trough was a 20% drop. Suddenly value starts outperforming. Why is that? Well, the overvalued stocks come down a lot. The cheap stocks find a bid. And that kind of gives you some insight into the next 25, 30, 40%, 6 to 18 month bear market. Suddenly the underperformance of value versus growth is going to get made up for and then some. Small cap, I'm hard pressed to argue against the liquidity or risk component to the small cap premium, but that doesn't mean there isn't a small cap premium. It just means it's a little more complicated than lesser known smaller companies with a less of a global reach. The other thing to think about is in a world of QE and ZERP, in a world of low cost capital, the companies who are going to be best able to take advantage of that are the really large global companies for obvious reasons. They have access to capital, they have access to markets, and if their business is good and they could make it better by leveraging, they'll do really well. So the other part of that answer is, as long as rates are relatively low, we shouldn't be terribly surprised that small caps aren't catching up to big caps. It's not that credit is anywhere near what it was in the pre-crisis days, but if you're a publicly traded big cap company with a global marketplace and you're not a lot of debt and a good credit rating, you have access to infinite capital at a very low price. That's tough to beat until suddenly rates go up or the capital availability declines. And I don't like to be a macro tourist. I don't like to just dabble in that. But that's a pretty rational explanation for why big caps are doing well. And I'm enough self-aware of my macro tourism to say I don't want to try and forecast when that's going to change. In fact, I just did a blog post earlier this week about the Wall Street Journal article about, so last week, Torsten Slok from Deutsche Bank, I used his chart to show the markets are really bad at forecasting Fed activity. It's really not good. You could look at the Fed funds futures rates and where the market thinks rates are going higher or lower, and the markets are consistently wrong. Not a little wrong, mostly wrong most of the time. So that was a really interesting chart. This week in the Wall Street Journal, there was a chart showing expectations of interest rates by fixed income investors. Also, mostly wrong, pretty much all wrong all the time. We just had rates dive over the past 6 months to the point where we're at the edge of a refinancing point where we're going to see a whole new round of refinancing for home mortgages. Everybody seems to have gotten that wrong. So when I see that data, and I know how bad people are at forecasting, and I know that you can't extrapolate what happened in the past 6 months into the future because there are so many intervening things that are going to happen: geopolitics, war, profits, death. There's so much stuff could potentially get between you and 12 months from now. The thought of saying I want to adjust our equity holdings based on credit availability and interest rates that benefit large caps versus small caps, it's like, really? Talk about introducing a layer of error and opportunity to make mistakes for what is really theoretically, it's not that value is losing money, it's just being outperformed by equity, which it's done for long periods of time in the past. So what I say to people who ask about that is, as long as rates are low, maybe you shouldn't have too much of a small cap tilt. Just be aware that you're going to be late in making those changes back to small cap and value once credit tightens up and rates go up. And by the way, you may not notice this for a year or two, and by then it's too late.
It's done.
So just don't even try. Just think in terms of decades and half centuries, and not in terms of rotating from this style to that or this cap to that. Or it's a fool's errand.
Totally agree.
So I have one last question, and our listeners know what it is. How do you define success in your life?
Control of your time. That's really the best way I can define it. I get up in the morning, I do what I want to do. I come to work, I work with people I want to work with. I basically, on rare occasions, have to do stuff I don't want to do. Like, I hate homework assignments. And my wife has been saying for years that I am gainfully unemployed, that I would do what I'm doing if I wasn't being paid for it. So to me, that's a measure of success. The ability to do what you want to do when you want to do it, to work with people you like, to have a degree of intellectual stimulation, to work with clients you like. I get emails from people all the time I get emails from prospective clients and from clients who kind of know my likes and dislikes, and so the guys who are car guys, and it's all guys so far of that, or the people, which are guys and girls who are tech heads. Like, I'll get emails from people with really interesting, hey, did you see this? Now, if it's in like page 3 of the Wall Street Journal, I probably did. But when someone sends me some esoteric triple E discussion of how Moore's Law has been thrown out and now we're accelerating, and that it's potentially capable of putting even more transistors on the path towards quantum computing, that's fascinating. To have all these people out there who share some of my interests. I mean, how much more can you ask, really? I don't know how other people define success. Just leave me alone and let me do what I want and interact with people I want. I don't know what else to even ask for beyond that.
It's a great answer.
Control of time is about the best answer you can give. That's a very good answer.
Yeah, so thanks for this, Barry, very much. You have a huge impact, I know, on me. I've downloaded so many books from listening to your Masters in Business podcast. Like, it seems like every week I'm downloading another book on my Kindle. So you're having an impact daily.
That's everybody's favorite question. There's 700,000 books published a year and nobody knows what to read. So when you get somebody who's intelligent and talented and competent and says, I really like this book, I've found that, again, I do everything for an audience of one. The reason that question is there is if I get a Ray Dalio or a Howard Marks, tell me what you read. So my dirty secret is all the books you hear recommended on the show. I audit the tape before that's broadcast. I order all those books. I have thousands and thousands of unread books at home, half of whom were recommended by the show. Jim Chanos recommended A World Lit Only by Fire. I never would have found that book otherwise. It's spectacular. I had no idea how horrific I knew they were called the Dark Ages for a reason. It's blacker than I imagined. It's horrible and more corrupt and more awful than I ever would have guessed. I never would have found that book without him.
It's great. Thanks a lot, Barry.
Thanks, Barry.
My pleasure. Thanks for coming in today.